Hi, I'm Mr. Simons, and in this video we're going to go through one short answer question, a Finance Business Studies HSC short answer question to look at the kind of information you need to include and really how to break down the question so that you understand what you are being asked and you can potentially access those higher marks. So if you want to give this a go before we get stuck into this, it's from the 28 Business Studies HSC and it's question 24. In the Business Studies HSC, as of 2021 still, that each short answer question of the four, each one is focused on a particular KBF. So this one is for finance. So I'll put the question up on the screen so you can take a look at it. If you want to give it a go first, do that. Come back, join me. We can go through some ideas. Okay, let's get stuck into it. So 24, part A. Why is liquidity an objective of financial management? I find this question pretty difficult because it's kind of like, well, of course liquidity is an objective. And then it's like, if someone says, why is it an objective? And you're like, well, because liquidity is good. So in terms of answering this question, I might start by sort of stating what liquidity is and why it is important. So we might talk about the fact that liquidity involves a business meeting its short-term financial obligations. So financial obligations, short-term. Solvency, that's long-term. So less than 12 months here with liquidity. Why is it an objective? Well, it's an objective because if a business doesn't have liquidity, that means it can't meet its short-term financial obligations. If it can't meet its short-term financial obligations, well, it might incur late fees if it can't make supplier payments. Maybe they charge a penalty on the business. Maybe the business would incur interest payments because it can't meet the costs of short-term debt or long-term debt to lenders. Also, if a business doesn't have liquidity, if it can't cover its short-term financial obligations, maybe its reputation falls in the market. Maybe suppliers are less likely to do deals with them, or maybe they charge them higher fees because it's like, you guys, you're a bit of a risk, so we need to cover ourselves by charging you higher fees. In trying to answer this question, the way I would put it is that liquidity is an objective because if a business doesn't achieve liquidity, then all these problems can arise. And if these problems arise, they could threaten or undermine the business's long-term viability. Maybe if a business isn't liquid, then it can't succeed in the long term because it can't make it through the short term. Those are the kind of things that I would put down. I would encourage you to try and word it yourself to see how you would combine these ideas. I think it's a bit trickier than it initially seems. If we look at part B, it says, how could a business improve management of its accounts receivable turnover? Okay, so how could it improve? So that's signaling to me they want strategies here. So I might start by thinking about, well, what does accounts receivable turnover mean? I'm just looking at my notes as we go so I don't miss anything. So the accounts receivable turnover number, that's really telling us how long does it take to collect money from debtors. Debtors being people that owe us money. Creditors are people that the business owes money to. If we can reduce the accounts receivable turnover number, if we can make that lower, that means that the business is able to collect debts faster. If a business can collect debts faster, it can improve cash flow because more money is coming in, and then improve liquidity as well. I think it is worth including a sense of this here in terms of talking about why is it important, very briefly. And then the how. How could a business actually do it? Okay, so one strategy. The business could use factoring of its accounts receivables. So the business could sell its accounts receivable to a finance company who will then go chase the debts. But the business will have to accept that it may only get the value of 90% or 85% or whatever the factoring company is going to charge. So just in a slightly different way, that the business sells its accounts receivable, the factoring company gives the money to the business minus a fee. maybe 10% of the value of accounts receivable. Maybe less, maybe more. Who knows what the business is going to charge? Another strategy would be offering discounts, early discounts, discounts for early payments. Oh, finally, discounts for early payments that would encourage debtors to pay up, shrink the size of accounts receivable, and improve cash flow and liquidity. So here we might say that the business offers a 10% discount for early payment or on-time payment. That would help to reduce the accounts receivable turnover, make accounts receivable be paid more quickly, and get the cash flowing into the business. So a small bit of explanation and two strategies here I think would put you in a position to do quite well. Okay, so then we get to question 24C, worth 5 marks, so pretty substantial. A business has decided to expand into a larger factory and is now considering its financial options. So if I'm reading this question and trying to decode it, that I'm reading in there, okay, so they're looking at how would the business finance this strategy? Financial options, what are the finance strategies that it would use? So I'm just trying to place it in the syllabus. The other thing is, in the second part of the question, discuss the use of leasing and the use of mortgages as the source of long-term finance for the business. Okay, so I know leasing and mortgages, they've been so kind and given me 2 specific things to talk about, and they've used this word discuss. What I need to do is, every time I see discuss, is I need to think about what are the pros, what are the cons. That's a really important part here of trying to answer this question correctly. So what I would do is, for each of the strategies it's given me, and don't include any others, it only wants these, I would give a short description of what it is and then pros and cons. So let's start with mortgages. Mortgages, long-term external source of finance, that we are receiving a loan for the purchase of a property, and the property is being held as security in case the business cannot repay the loan. Pro. Once the mortgage is paid, the business owns the property. It is an asset for the business that is not shared among any other parties. So the business fully owns the property at the end of the mortgage. What are the cons of the mortgage? It costs money. So a business has to repay the principal, interest on the principal at the interest rate, plus any fees or charges that the bank charges for the privilege of borrowing money. So in terms of the con, it would be the cost of taking out the mortgage, the cost of this source of finance. If I then go to the lease, the use of leasing here might be a bit tricky, because you're thinking, isn't leasing for like equipment and things? Why would you be leasing a factory? That here I would encourage you to think about leasing like renting. So rather than buying the factory with a mortgage, that instead the business is going to rent the factory, rent the premises. Okay, what are the pros of renting? Well, the pros of renting in this context, or the pros of leasing, to use the wording from the question, let's go back. How would we explain leasing? Okay, so in leasing, the business would rent the factory and pay the owner for use of the factory, or use of the asset, or use of whatever, right? That the business is paying for use and that it is not taking ownership of the asset. It is just paying to use it. What is a pro of leasing? Well, lease payments are tax deductible. So lease payments are a business expense, so that the business can claim the lease payments off its tax. So that's an advantage, because you can reduce the amount of tax that the business would pay, which would increase the amount of profit that it would be keeping. The other thing you can think about leasing is that it gives a business flexibility. So by renting this factory, if circumstances change and the business needs a bigger factory, a smaller factory, or no factory if things go badly, then the business can exit the lease. And yeah, okay, there might be a penalty for early termination of the lease, but it is much easier to exit a lease than to try and exit a mortgage. In order to exit a mortgage, you have to sell the property, because you need to give the bank the money that you owe them. Oh, another advantage of leasing, just in case, is that the business doesn't have to pay for maintenance on the property, that would be the responsibility of the owner. So that could be another pro there, but I think those other two, the first two, are stronger. So the cons of leasing is that the business will never get to own the property. At the end of the lease term, that's it. The business hasn't paid off the asset or bought a share of the asset. They're just paying to use it. So, disadvantage is that at the end of it, the asset still belongs to the owner. Some people see rent as kind of dead money, that it's money you are throwing away because you are not building equity or ownership in something. I disagree with that because you may not be able to afford the whole property and that you need a property, so rent is actually really important in that circumstance and necessary. But that might be a small aside in terms of that. So that's how I would go about answering question 24 in this context. Those are the kind of things that I would include. If you've got any questions or issues or things you want to clarify, just put them in the comments. If there are any other short answer questions that you would like me to go through to pick apart in this way, then just list them in the comments and I'll add them to the list of videos for me to do. Anyway, thank you very much for watching and I'll see you in the next one.